everyone. My name is Jen Liu. I'm a real estate and finance lawyer at Carlton Fields and also head of our development industry group. First of all, welcome everyone to our community and development program hosted by Carlton Fields Development Industry Group. We launched the community and development series in the year of 2018 to curate an experience and a community in which sound and innovative development ideas can spark, development enthusiasts can convene, and development challenges can be tackled. Since then, we have successfully hosted a number of programs covering topics from mayoral candidate debate on the issues of development to the Tampa Bay Rays Stadium, from development and financing issues involving the cannabis industry to waterfront development, just to name a few. So today, we are so excited to have an esteemed panel with us to discuss another timely yet very significant topic, which is condominium development in the aftermath of the Surfside condo collapse. Before I turn it over to the panelists, I wanted to first of all introduce my law partner and a highly regarded condo lawyer, Bill Sklar, to everyone. Bill will be both a speaker and the moderator of our panel today. Bill served as chair of the Florida Bar's Condo Life Safety Task Force after the Surfside tragedy. Bill Sklar is also the chair of Carlton Fields Government Law and Consulting Practice Group and managing shareholder of our Tallahassee office. Bill represents both developers and lenders. He assists them with planning, drafting, and the development of residential, commercial, and complex mixed-use condominiums and planned developments. Bill also serves as regulatory counsel in compliance matters under numerous federal, state, and local statutes, regulations, and ordinances, and also is a lobbyist for the real estate development industry. Bill, if you think he still has time, he's also an adjunct professor of law at the University of Miami School of Law and is a member of the faculty of the LLM program in real property. He is the director of the University of Miami's Ralph E. Boyer Institute on Condominium and Cluster Development. Bill is also certified by the Florida Bar in both real estate and the condominium and planned development law, and by the Florida Supreme Court as a certified circuit and county court mediator. He is also a member of the Board of Governors of the American College of Real Estate Lawyers. So now, before I turn it over to the panelists, I also wanted to do a housekeeping matter, which is to announce that the webinar we're about to start is being recorded for educational and training purposes. This recording may include questions and poll responses provided to you during this event. This recording will be made available after the conclusion of the live event. So if you have friends and colleagues who wanted to view the event but cannot be here live right now, you can send the link to them afterwards. So without further ado, I'm turning it over to Bill.
Jen, thank you for that warm introduction and for coordinating this in a series of Carlton Fields Community and Development Forums. Thank you. Before I begin, I'd like to introduce the other co-panelists that I'm honored to share this webinar panel with. First, we have Andrea Northrop, Vice President and Partner with the Insurance Office of America, Florida's largest privately held insurance agency, where she is real estate practice leader for the West Palm Beach office, a member of the Real Property Insurance Committee and Condominium and Planned Unit Development Committee of the Reptile Section of the Florida Bar. Andrea specializes in condominium and homeowners association insurance risk consulting and placement. She is an author, including the Condominium and Community Association edition of the Florida Bar's Green Book, a leading resource in the area, a graduate of the University of Florida, and her law degree from the University of Missouri, Kansas City. We welcome Andrea Northrop. Also joining us today, we're pleased to have Rick Slider. Rick Slider is the principal and CEO of Slider Engineering Group, based in Palm Beach County, but with offices throughout the state of Florida. Rick has a structural engineering, civil engineering degree from the University of Florida, graduate studies from the University of Tennessee. Rick is a licensed professional engineer, PE, in several states, among them Florida, Alabama, Georgia, and Tennessee, and is very active as a project manager and serves as a certified threshold inspector. Rick's technical expertise for more than 40 years has been to represent and provide forensic investigation and litigation support, as well as expert testimony in the recovery of damages for material and construction defect and failure. And I know from having participated with him in the Florida Bar's Construction Law Institute, you're in for a very interesting chat with Rick. Also, we're very pleased to have with us Bethann Barrett. Bethann is a commercial lender specialist in association lending with Bank OZK for over 22 years. The author of Bank OZK's association lending policy and a go-to expert nationally for questions about lending to common interest communities. We're very pleased to have Bethann Barrett, Senior VP of Commercial Banker from Bank OZK. And those are our panelists. So what I'd like to start with today, if we could go to the next slide, please, the tragedy. And we can go to the next slide after that, please. You see what was invariably what has been reported as the third worst building collapse loss of life in the United States. However, when we take into account the terrorist causation of the first two, the Twin Towers and Kansas City bombing, indeed, the Champlain Towers South loss of life was the worst building collapse tragedy in US history. Besides the obvious human tragedy, if we go to the next slide, showing the site today, and if we could go to the next slide, please. The issues raised by the Surfside tragedy are very significant. If we could go back one slide, thank you. What's going on as we speak is very significant. Undoubtedly, many of you have heard the recent news as of yesterday that the Florida legislature is about to adopt the most significant condominium and cooperative life safety protocols and guidance in the history of real estate and condominiums, particularly in the state of Florida and the nation. As we are addressing you, the House of Representatives is debating the amendment containing many of the recommendations and others of the task force that I had the honor of chairing, as well as those of many other fine task forces and organizations, including the International Code Council, BOMA, and others, who looked into not the causation of the tragedy, but the life safety guidances and lessons learned. So what are the issues raised by the Surfside tragedy? First, the difference between maintenance protocols in residential condominiums and any other form of real estate. Understand, unlike retail, industrial, civic buildings, any other type of real estate where you have lenders, where you have private equity, where you have third-party investors, residential condominiums are managed, are run, operated by a well-intentioned group of volunteer owners. And it is in their discretion whether there would be maintenance or inspection protocols. Thus, the lack of any maintenance and inspection standards. Further, the need for transparency and disclosure. We heard as a task force numerous reports where indeed there were engineering reports, not Champlain Towers South, but other properties. But because of the results, because of the findings and recommendations, and yes, because of the cost, in many instances, it was alleged that boards of directors sat on those reports and either did not disclose them to residents, members, owners, and did not disclose them to local building officials, or selectively chose what it wished to disclose. A very unacceptable standard. The funding standards for deferred maintenance and capital replacement, what is referred to as reserves, and what some have referred to as the 800-pound elephant in the room. Why spend money on future needs when you can kick the can down the road? And another unacceptable condition of residential condominium governance. The unique nature of residential condominiums regarding lending, underwriting, and insurance underwriting, which we'll hear from our experts in just a moment. If we could go to the next slide. The role of professional management, and sometimes lack thereof. Again, well-intentioned volunteer directors, the need for professionalization of management. Just think of this. In every company, entity, typically there's a CEO, COO, CFO. Now, no one's suggesting we spend hundreds of thousands or millions of dollars in every condominium to go to outside management, but the need for professionalization, such as in the private sector to report to the board of directors, became very much a focus. The borrowing ability of boards, many developer counsel, thinking that they were protecting the interests, balancing the interests of unit owners, and the vast authority, fiscal authority of boards, placed constraints on boards to borrow money for deferred maintenance and necessary repairs, only to learn that this became a hindrance and a constraint. Indeed, the role of local government, with a backdrop of almost absolute sovereign immunity for the past 37 years because of cases finding that these were ministerial acts, the act of building official inspections, that negligent building official inspections would not be actionable against local governments, and the potential lack of accountability, the lack of unit owner remedies, and the effects on developers and lenders. If we could go to the next slide, please. Building obsolescence, and what will occur as a result of this, that being terminations of many condominiums where repairs cannot be economically justified. The role of local, state, and federal governments in deferred finance. There's been introduced into Congress. We do not know whether this will travel legislatively. In the House, a bill seeking infrastructure money be transferred, and there be federal subsidies or guarantees of loans for deferred maintenance. Government accountability, as I just alluded to, and the need for more robust enforcement and inspection by local governments. Insurance, we're about to hear of that. Let me go to the next slide, please. And very briefly, before I mention what is going on in the current legislation, the task force recommended what I call TRIM: transparency, reserves, inspections, and maintenance. Maintenance, a standardized protocol, including the developer having a role, since there's already in our Condominium Act 13 categories such as electrical, plumbing, structural, where there has to be an inspection at the time of turnover of control from developers to unit owners, that be used, and added to that, obtaining a standardized protocol as a guidance for condominium associations. The need for credentialed inspections, credentials by qualified individuals. Unfortunately, the task force heard many stories of what's known as an abuse of engineer shopping, where those having no credentials would gain a report of an engineer, take pictures of the property, put it together, and go to boards of directors saying, we can do this for a fraction of the cost, you meet your fiduciary duty, and all is well. When there were no credentials, the content was not specific to the property. Further continuity, when will these occur, and the transparency. With that said, I'm going to skip the next couple of slides, and I want to talk about the current legislation that has passed the Senate last night and will likely pass the House in a matter of hours. There is an milestone inspection standard. Phase 1 and Phase 2, a visual by an engineer or architect. And if that reveals any structural deterioration of any substance, you go to a Phase 2, which could include destructive testing, and a report by that qualified professional. And based upon several elements existing, much of which is in our statute: electrical, plumbing, structural, load-bearing walls, and structural membranes, among other line items, all to be basically indicated as a milestone report. It would be done for those condominiums within 3 miles of the coastline, 25 years after a condominium certificate of occupancy. And for all other condominiums, 30 years, and each 10 years thereafter. So what does that mean? Well, the task force found back in July that 62%, or 922,000 of 1.5 million units, were already 30 years of age. So a vast majority of units will be covered by this. Before, up to this point, literally, other than 40-year recertifications in Miami-Dade and Broward counties, there is no standard in the other 65 counties, despite there being a vast majority, 2/3 of all the 1.5 million condominium units, with over 2.5 million of Florida's residents in these units, no standard for maintenance, no standard for inspection. So when these inspection reports are provided, they also have to be provided to local government building officials and to all residents as an official record, with a remedy on the part of individuals, unit owners, to force that these inspections be done and that they be distributed to the unit owners if a board refuses to undertake the inspection. Besides that, a robust reintroduction of what's called a minimum structural integrity reserve analysis and there is a question in its implementation whether it's to be done by an engineer or architect. Some of us read that to be the case, or it could be by a non-credentialed or credential lacking an engineering certification or license, I should say, or architect license to perform those. And those would have to be performed every 10 years. So those are among the major components, except for reserves. There will no longer be waiver of reserves, either by developers for the first 2 years or by associations. No reduction, no waiver, no kicking the can down the road. There is a question over the financial burden placed upon associations and the funding, and that has yet to be interpreted. But right now, the House version, already adopted by the Senate, calls for full funding of 10 enumerated items in 3+ years. This essentially would go into effect, although immediately, July 1, but much of this would take effect December 31, 2024, as far as the time to obtain the inspections, to obtain the reserve analysis. That's a thumbnail sketch of over 100-page law that has yet to be passed, but likely to be passed today. With that said, I'd like to move to the insurance aspects of this. This all is coming about as we are in a special session to address the property casualty crisis going on. And with that, I will hand it over to my colleague, Andrea Northrop.
Thank you, Bill. I appreciate being here today. Thank you to Carlton Fields for hosting the best way to understand where we are is to see where we've been and how it's progressing. And so prior even to the tragedy that occurred at Champlain Towers South, we were already seeing rumbling in the marketplace of bad things to come, would be the best way to put it. We had been in a soft market from 2013 until about 2018. And that's really when the market had bottomed out. We had seen in that period of time new carriers coming in. It was a bit of a race to the bottom for rates, terms. They were throwing in a lot of extras on different policies. And it really came to a screeching halt in 2019. And from 2019 until now, we have seen not only all of the rate taken back for what we had seen that was given from 2013 to 2018, but we are well exceeding the rates. The effect on the marketplace for Champlain Towers South has been a lot of underwriting changes. And so you take this precarious marketplace, not only in property, and I know right now with the legislature reviewing this, so much of the focus is on the property because there is significant expense associated with property. But we're seeing this carried over into the general liability marketplace, the directors and officers marketplace. It's going to affect even the crime fidelity bonds that associations are obligated to carry, and then the umbrella or excess marketplace. And it is rapidly pervasive. So what we're seeing from carriers is a response, a good number of them who immediately said, we're out. We're just going to non-renew particular classes of business from the very beginning. We saw a primary general liability carrier where they drew a bit of a line in the sand, literal and figurative, that said, you know, if you're over 20 years old, you're more than 4 stories, you're within a mile of the coast, non-renewed, we will not be offering renewal terms whatsoever. And we are seeing that in the property marketplace at the same time that we're losing carriers who have gone insolvent in the last few years, not just the unit owners carriers, but those policies for the master associations policies, the ones that the boards are obligated to secure to ensure the roofs and the windows and the board and the structure of the buildings themselves. So we're seeing this take place in what I would say is a perfect storm. And the perfect storm is coming on the rate increases. It's coming on the restriction of terms. It's coming on the increases of deductibles. And it's happening at a time where you just said, so if we figure at best for what is in front of the legislature right now, you know, the introduction of this $2 billion reinsurance fund, reform with regards to how solicitations can be made with regards to roofing claims from roofing contractors, the general consensus is it's going to take at least 1.5 years before they're going to start seeing any rate relief. And that's going to be 2 hurricane seasons. So we've got to get through hurricane season of 2022 and again in 2023 and see what markets survive and hope that it holds together long enough for these legislative changes to give some relief, because we have primary carriers that a year ago were offering a 1% hurricane deductible, which if you're an association with $70 million of insured value, 1% is still a significant amount out of pocket. But we're seeing those same carriers now only offering 10% named storm deductibles. And that's a huge swing. And the associations, many of them can't take a 10% named storm deductible. They have to have a 5% in order to satisfy many of the mortgage requirements, which I know Bethann can address more specifically. And it's a matter of tying those together. When we're looking at form restrictions, so it's not just in deductibles, the older the roofs, then we've been seeing the actual cash value endorsements coming on. So instead of getting replacement cost for your roof, after you apply this massive deductible, the roof is going to be depreciated based upon its remaining life expectancy. So that's going to be an additional out-of-pocket expense for our associations. As our buildings are aging, as they're most in need of ordinance or law coverage, we're seeing the carriers pull back on ordinance or law. So where, you know, they're grandfathered in based upon the way they're built to the code for 1975, 1980, the appraising the replacement cost for that building is appraising it as it stands currently, like, kind, and quality. But if it burns down, if it blows away, the city and the county are not going to allow those associations to put those buildings back up as they stood. They're going to make them put them back up to 2022 code. That's millions of dollars in excess of the true replacement cost as they stood the day before. All impact windows, changes in the balcony railings, the sprinkler systems, the elevators, the smoke alarms. I mean, there's a huge amount of expense associated with ordinance or law. Carriers that might have been offering $10 million of ordinance or law 5 years ago might be offering $2.5 million today. And that $2.5 million might be a sublimit of coverage, so it's built into the total amount of insurance they have. We've seen carriers on the general liability putting on collapse exclusion forms as a result of the tragedy. We have seen far more subtle in their attachment, what is called a continuous and progressive injury exclusion. And so what it's saying, even known or unknown, if it started happening multiple years in a row, and maybe you've got 5 general liability carriers who've been on that loss over the last 5 years, if each one adds a continuous and progressive exclusion, and then the final one is the one where you have a loss related to the maintenance issues, you're going to find yourself without sufficient coverage to cover that loss. From an underwriting standpoint, the desire for an engineering study, not just the recertifications, absolutely for the recertifications if you're going to be in Miami or Broward County, but for those buildings that are older, that are barrier island, the underwriters want to see an engineer's study. They want somebody to put pen to paper that says this building is structurally sound. And that, I think Rick is going to be able to address. That's a big term for somebody to sign their name on letterhead, for an underwriter to feel comfortable before they're going to issue terms. And they want to see that in writing. They want to see, I've had one carrier up to 12 months of board meeting minutes before they would issue a property quote. Same on the general liability, same for the directors and officers. Across the board, they are now looking at this. And I'll say the ripple effect of what we're seeing so far has been not a positive one, because as we've had associations having to obtain these reports, we are seeing it's not so much what happened in Surfside was the exception. We're getting a lot of bad engineering reports back. We're finding a lot of issues with a lot of communities where they have been kicking the can down the road and a blind eye has been turned, and now they find themselves in that precarious situation of cat's out of the bag. You can't get insurance now. You can't get the funding to fix the problems that you might have had, because now there's a building that might need to be evacuated until the repairs are going to be made. You're not going to get a general liability carrier who's going to want to pick up that exposure. And you're not going to get a directors and officers policy to protect the board who's going to be left with making these decisions. And you'll probably find yourself in a really difficult situation with regards to who's going to continue to run this board to get you through that hard period of time, to do the repairs, to get the loans. And Bill, this kind of ties back into the developers looking at the buildings and saying, if it's not financially feasible to do the repairs, is that a termination situation? Is there going to be an opportunity to sell the building and you're just going to have to move on? But from the insurance side, we're seeing significant underwriting changes with regards to those structural differences. And this is just kind of a salt in the wound, if you will. A lot of those policies already have exclusions related to many of these things. There is no coverage for wear and tear. There is no coverage for construction defects. There is no coverage under a directors and officers policy, most likely, for bodily injury, illness, disease, death, loss of use, loss of value. Those are all already exclusions. So these boards really need to take a serious, hard look at what their obligation is and what the market is doing, and what these underwriters are really, they're not going to be taking anybody's word any longer. And if you just had a hard property market alone, it would be one thing. And we have a collapsing property market. We have one where carriers are going out of business far too rapidly. We're hoping 18 months on the positive side for saving our property market. There's no backstop on the liability. There's no backstop on the directors and officers, and there's no backstop on the umbrella.
Andrea, let me ask you a question, if I may. So you gave examples of increasing deductibles, not only for the roof and not only for hurricane, but just to clarify, this is for all casualty coverage. We were accustomed to that on a windstorm hurricane, but now we're talking about for all casualties, which goes beyond windstorm, obviously. So what are you hearing from the associations you consult with, the clients you consult with? Are they setting up financial reserves to cover these increased deductibles? What's their financial reaction or attitude towards that, other than despair and frustration?
Despair and frustration would be accurate. I would tell you it's like a vice coming at them from all different sides. Because at the time where they need to look at, do we have enough money to meet a doubling deductible, or a tripling deductible, depending upon what their expiring was, they're trying to meet 40 to 80 to 100% increases on their premiums alone. And so if they're not budgeted even for the premium increase, there's no money left for them to look at, even establishing a reserve to meet the deductible. So it's going to be extremely difficult for a lot of these associations, because one of the things that ties into that we didn't mention is the associations have to have those updated appraisals every 36 months. So we have associations right now, they're at their 36th month, they're coming up for renewal. The supply chain issues have now said, as a result, putting that same building back as it was is a 40% increase in replacement cost value. That 40% more insurance you're going to purchase is going to come at a 60% rate increase. And that 60% rate increase is going to come with double deductibles. And so not only do you not have a 3% deductible, you might have a 5% deductible, but it's not 5% of $50 million anymore. It might be 5% of $75 million that you have to purchase now. And that becomes an astronomical figure, and they can barely tackle paying the premiums.
Do you hear them mentioning the dirty term special assessment to cover the increased cost, the deductibles, just the increased premiums that were not anticipated in their annual budgets?
Absolutely. I have done quite a number of special assessment meetings this year so far, to stand up there and explain, here's where the market was in September when you set your budget. Here's what we were expecting. Here's everything that's changed since then. Here's why the board couldn't have anticipated what's going on. And the only way they're going to be able to pay their bills is with an assessment.
Yeah. Don't you agree that this necessitates more of a longer term view from a financial health standpoint of these associations? Because as you said, and you answered my question I was anticipating asking, the net increase since the tragedy 11 months ago, and you mentioned 40% to those buildings that don't have reserves. I assume they're in the category of 100 to 200%, as you mentioned. So it's not only let's be able to pay the premium for the upcoming renewal or replacement coverage, if you will. And I'm not talking about full replacement. I'm talking about to replace the insurance that's either terminated or expired. But aren't we talking about setting aside money for the foreseeable future for these increased insurance costs where the coverage can be obtained?
It's definitely something we're going to have to consider. More often than not, one of the things we do in addition to showing our clients what the private marketplace will offer is showing them where Citizens is. Because if the only market we have left is Citizens, that helps them anticipate, at least for now, what the published rates are, to say this 40% rate increase was awful. However, it's still 30% less than where you would be if we had to go into Citizens. So if you budget to the worst and then let's hope the market maintains, I just don't. The average condominium association, I mean, aside from the beautiful and the barrier island and our high rises, the majority of our condominium associations are more towards, retirement side of life. They're usually on fixed incomes. They do not have the financial wherewithal to absorb the increases that have been coming 3 years in a row and are coming at a higher, almost exponential rate now.
Yeah. One final thought. You and I participated in a live presentation about a month or so, maybe 2 months ago, and we heard the term mentioned from one of our co-panelists that condominiums represents the affordable housing component And now, in light of these additional costs, in light of what you're going to hear from Bethann on the financial side, in light of what we're about to hear from Rick on the reality of aging buildings, there's a real question of whether that's a viable component. Would you agree, of affordable housing? Do you agree with that?
I do agree with that. And I think it's been an illusionary affordable housing because the kick the can approach without reserves has been taken. So if you weren't reserving and you weren't maintaining the building, it was far more affordable to live in there. And if you have a simultaneous reserve mandatory requirement now, along with mandatory updates to the building, affordability has gone out the window.
Thank you, Andrea, for your perspective and the dose of reality that we're all facing. Our next panelist is Rick Slider, and I've seen his presentation, and go ahead, Rick. I don't want to give away what you're about to say.
Okay, let me qualify my statements first that I have not been retained by any party regarding Champlain Towers in any way. I've not done any kind of structural analysis, calculations, whatever. The comments I'm going to make today are really based upon the documents of record that anyone can obtain from the building department at Surfside and my experience in doing evaluations and the surveys for buildings. So for Champlain Tower, these are just some of the highlights. 12-story building, 136 residential units, and they were up for the 40-year recertification. You might have heard already the term, and Bill mentioned that looks like the new legislation may come out with a 25 and a 10-year. At present, only Miami-Dade and Broward County have what's called a 40-year recertification. And the intent of that is that an association would retain an engineer, could be an architect, but in most cases an engineer. They would come in and do an analysis of the building. They're required to look at the structural components and the electrical components. In this particular case, obviously, we're going to be talking about the structural aspect. The Association for Champlain Towers did hire an engineer, and they actually prepared a report which they issued to the association in October of 2018. This is significant in the sense that the collapse actually occurred in June of 2021. Next slide. So the survey that was conducted did include a review of the original architectural, structural, mechanical, electrical drawings. That's pretty standard for the process. They did review about 50% of the units. There's no requirement as to the number of units which are to be inspected under the protocols for either Miami-Dade or Broward. But as a general rule, I would say 50% was a reasonable number. Next slide. The report that they filed, or they prepared, basically highlighted a couple different areas which raise a concern. The bigger one is that the waterproofing at the concrete slab areas where there's a plaza deck had failed. And we were pretty adamant about that in the report that they prepared. And they made the statement, failure to replace the waterproofing in the near future will cause the extent of concrete deterioration to expand exponentially. And that's a very true statement. Concrete's a fairly durable material. We use it a lot in South Florida, actually around the country, but a lot on the coast in South Florida. And it performs very well. However, over time, when exposed to the environment, the salts, the steel within the slabs deteriorates, and as it does, it breaks the concrete off. So this comment is a very true statement. The engineer noted that in the report. They also indicated there's a replacement of the existing deck. And again, it has part of the issue on this project is they had a pool deck elevated above a garage. They had a waterproofing system with pavers, and they identified that the system had failed. Yet you cannot see it without doing exploratory examinations. And one of the things on the 40-year recertification is it only requires you to do visual observations. And I'll talk about that further. Next slide. So these are some of the other comments they had. There were prior concrete repairs in the garage. That's also a concern. You may not know the quality of the work that was done by other contractors. Again, we're typically in a competitive bid market. Some contractors and engineers do better work than others, but they did identify there were prior repairs and that some of those repairs were now failing again. Again, they also identify abundant cracking and spalling. All that spalling means is the concrete is breaking off because of the deterioration process. Next slide. And their comment or recommendations is the distressed concrete be removed. And that in essence, they're saying that the entire, not only the waterproofing for the deck, but also the concrete slabs need to be replaced in their entirety. That is a big deal. A lot of times we can repair structures in part or pieces and rehabilitate them back to a point where they're structurally code compliant and they perform as they're intended. Whenever I see a report that says you have to replace them in their entirety, raises the criteria for me a little bit that's pretty extreme. Next slide. And the other factor that was important is in 2018, they reported the cost of this repair to be about $9 million. I'll tell you, and some of the other speakers had mentioned, we've done a number of these 40-year recertifications, and there is an extreme amount of pressure on occasions put on engineers, because when they published this number saying 9 million, and my guess is it was probably more than that, there's a lot of pressure because they don't have the reserves and they don't want to have to come out of pocket for it or assess their owners. And there's a lot of politics regarding the boards. And I've had owners or boards come to me and say, we can't do this now, we want to defer it. Or we want to get somebody else's opinion on it. And it is a very big factor as far as the reporting by some of the engineers. Next slide. Now, the other thing that's significant here is this report done in 2018 identifies these issues. It was supposed to have been turned over to the building department in 2018. Yet this is, if you go to the public records and pull up this report, you'll note that it identifies the building department actually put this header on the report, saying it was submitted to them at 5:35 p.m. on the day of the accident. That's in 2021. The original report was October of 2018. That's highly irregular, and it should have been done before. Don't know if there was pressure put on not filing the report later on, or those other kind of conditions, but I have, in my experience, seen that happen. Next slide. Now, these are actual photographs out of the report. You don't have to be an engineer to understand that this doesn't look right. These are photographs from the underside of the slab. This sort of an orangish color is corrosion and water product that's coming from the balcony above. If you remember in the report, they talk about the waterproofing failing. Now, within that concrete slab is reinforcing steel. And that reinforcing steel wants to revert back to an ore. It corrodes. And as it corrodes, it expands and causes the concrete to break off. When it's getting to a level that you can visually see the corrosion on the bottom side of the slab, that's a considerable factor. This probably would have warranted doing an exploratory examination to identify the extent of the damage. And some of the other areas you can see, it looks like somebody attempted repairs previously from the bottom. You cannot fix waterproofing from the bottom of the slab, and you cannot fix the steel corrosion from the bottom of the slab. Next slide. Hey, this is another area of the garage. Again, these are photographs out of the report. This is all areas where the concrete is beginning to break, to come off as a result of water migration through that slab. Next slide. This is another area. This is the entrance ramp from the street level down to the garage. What you're seeing, those sort of lines that are running horizontally, there's reinforcing steel within that slab. It is critical that the steel be intact and fully engaged with the concrete in order for the two to perform and provide the structural capacity. This is what we call a spall, and I would say a significant spall, meaning that the concrete is already broken off and that reinforcing steel is no longer fully engaged with the concrete. When it gets to this level, there's a big concern that the structural capacity of the slab cannot be provided, and as a result, it may lead to a failure. Next slide. This happens to be a photograph. It's a little busy, but this is underneath the pool deck. The pool is to the left where that the equipment is on the side, and the pool deck is to the right. What you can see a little bit is that the concrete is actually breaking off and the reinforcing steel is fully exposed. This would be an indicator to an experienced engineer that there is significant water migration and they've experienced significant structural loss of section in these areas. Again, to me, this would have raised a concern. At the least, I would have done further exploratory examination to confirm the extent of it, and obviously, if needed, put in shoring. Next slide. Now, as far as the 40-year recertification, in general, it has been in place for a while. It served a fairly good purpose, but it has certain criteria. One of them is that it's the minimum guide for the inspection. And the purpose of it is to confirm in a reasonable fashion, that the building is safe to occupy. That's really the intent and function of it. Next slide. There is no requirement for an engineer to go back and recalculate or determine the original design was appropriate. In many cases, building departments, especially buildings of this age, the records aren't complete, and as a result, some of the drawings aren't there, but even if they were there, it would be difficult to do an analysis of an original design because there could have been factors in the field that reinforcing steel was either not placed correctly, or it was left out, or other conditions. So for the most part, unless you see significant distress that would lead an engineer to believe that there's a structural issue, you're not required under the recertification to review the original design. Next slide. And in most cases, this is the parameter, is that it's a visual examination. I will tell you, I've done this for a long time. And I've seen younger engineers go out on project sites. They see a crack, a crack, and it's not always. I've seen many cracks. Some of they give you a clue or a pattern telling you what the distress is. You want to know where it starts, where it finishes, the alignment. All these are factors to give you a non-destructive means to assess whether this is a significant problem or not. One of the factors that I see is the associations commonly would retain or solicit bids from engineers. It's a very competitive market, and I've had occasions where we provided a number to do an assessment, and they actually selected somebody that maybe is 20% of our fee, and you can't do it for 20% of the fee. But what we find is that they hire an engineer to do it. He sends out a technician who has no experience or little experience, and while good intentioned, may not have the expertise to assess and properly diagnose what those cracks mean. So I have seen that on many occasions, and I'll show you some other slides where that becomes a factor. Next slide. Again, this is really based upon a visual assessment. You're to look at the main structural components. The other issue that's critical is a lot of the structural components are hidden, either by drywall in the interior, by elevator shafts. Sometimes we have garage areas that are open, or stairwells, and we'll take advantage of those. But in order to get back to the structural components and the essential components, you may have to do exploratory examinations. That costs money. And a lot of times associations, if we come to them and say, hey, this is a criteria we need to open something up and disturb the existing conditions. Number one, they don't want to be inconvenienced, and two, they don't want to spend the money. So it is a factor. Next slide. And the guidelines from Miami-Dade, this is what I'm pulling this from, basically says that you can do chipping and exploratory examinations, which is what I suggest, but it's not a requirement. Next slide. Again, I've sort of covered this. It is a visual examination, is the protocol that has been in place. It is to be supervised by a PE, a structural engineer, or an architect. But again, the qualification and the level of experience of an inspector is critical. And again, a lot of times there's a big cost factor between someone more seasoned and senior in the process than sending out junior level people. Next slide. This is an example. This is a newer building. Now this is over in St. Pete. What ended up happening here is they did have a turnover study that was done on behalf of the developer. Cracks were identified, but the engineer at the time made the assessment that it wasn't significant. And also the builder says, we don't think this is a big deal. We ended up coming in later on behalf of the association. We looked at this, and I can tell you from a structural standpoint, this is a huge deal. This is a post-tension slab, and that crack diagonally basically is causing that column to fail. Next slide. And this is we've opened it up on the outside. One of the things that we found was the post-tension cables that are within the slab are required to have 2 of them go through the column. And that's in part to make sure that the transition of the forces from the slab to the columns are in place. And what we found is they failed to do this. Again, the original engineer that did the study didn't think this was a big deal. We went in immediately and shored this up and subsequently had this repaired by a contractor. Next slide. This happens to be a project that I was involved in a couple of years ago. It did go into litigation. This is up in Cocoa Beach. And you can see this is a 4-story structure with exterior balconies. And you can see the second balcony on the right-hand side. That black area is actually where the balcony literally fell off. Next slide. This building had been completed for about 2 years. Actually, there was one owner in the building at the time this occurred. He heard this tremendous bang, and essentially what this is the entire balcony. You see the one sort of down below. It looked like that before, and it fell off. The only thing that held it in place was a couple of bars that were placed to the interior of the slab at the bottom. And what ended up happening here through the testimony, again, this was one of those projects where the engineer of record was retained. They had a substantially low fee. The engineer of record on the project had a junior staff level engineer, was not a PE at the time. He did the design. He admitted in testimony, I've never done the design of a post-tension balcony slab. He also was the individual that reviewed the contractor's work, the submission of the documents. He had never done that before. And he was also the engineer that served as what they call the threshold inspector, meaning he reviews the structural components on buildings of this level. And he had no experience with that either. Come to find out, the top reinforcing steel, which essentially holds this balcony in place, was not installed. We went back and examined the other balconies and found, in fact, that they were all installed without the required reinforcing steel. So it can be a very big factor. Again, it does have something to do with the experience level. Next slide. One of the things that we see, especially in South Florida, but it's common throughout Florida, and there are discussions whether new buildings or old buildings. And this happens to be a post-tension slab. I guess this is a very close picture. But what happens on a post-tension cable is that the middle part where you see there's like a grouping of 3 or 4 little round pieces, that's the actual cable. The way it works, it's like the kid's Chinese finger, where you put your fingers in and the tighter you pull on it, it clamps down on the fingers and therefore you can't pull it out. Essentially, this works in the same way. One of the issues is that a lot of times when they're built, there's no protection for water getting to these anchors. They're metal, they are tend to corrode. And go to the next slide. And what they do, these are just happen to be 2 of the wedges. And those little grooves on the inside of those wedges, it's like a nut that you would put onto a bolt. There's 29 of them. And those little teeth that are in there grip onto that cable. Well, as the water gets into the wedges, and if it gets water in there, those teeth corrode and erode away. And as a result, let loose that cable. So it can be a very big factor. That's one of the things doing new construction. A lot of times contractors make mistakes with. And on older buildings, people try to, again, not do the repairs. And the problem is they're terribly expensive to do. Next slide. Again, this just happens to be a lot of times when we do these kind of repairs, when we're doing the studies, we'll pull those out. This happens to be under microscopic examination of the teeth, the little ridges at the top of the teeth, but you can see the fracture lines in between. And microscopically, you can see that this is already beginning to fail because of the corrosion and beginning to break off. Next slide. There are occasions where there may be distress or concerns with the cracking in the structure, and it's not clearly explained either by analysis or the observations. And where we feel like there's a concern, there are many cases where you can actually do testing. So in this case, we set out a grid. We actually put what they call crack gauges, and we monitor it over a period of 6 months or so and identify if it's moving, is the distress getting bigger or smaller. But there are certain techniques. Again, these techniques cost money, and a lot of times there's pressure put on the engineer not to spend that kind of money to make the assessment. Next slide. This happens to be a building over in St. Pete. The building is about 45 years old. There is no criteria in Pinellas County or St. Pete this time to do a recertification like it is in Miami-Dade. The building owners, however, were being very proactive, called us in to do a structural assessment. And this happens, you look at this, it doesn't look too bad. The owners have maintained it fairly well. Next slide. What we did is we opened up, cut out that same hole that I showed you just a second ago. And this is the inside of the wall. That wall has got light gauge metal framing with a stucco cladding on the outside. This building has been experiencing water infiltration for a long period of time. This is structurally compromised, and we're preparing plans now for the association to implement the repairs. And again, they did their job by maintaining it. It looked pretty good, but on the inside, it was terrible. Next slide. This happens to be another project. This is in, I think, Hollywood. Again, this is a pool deck. Doesn't look too bad. Maybe it's a little bit dirty, but overall, the performance of the tile, the pool, and all that don't look too bad. Next slide. We go underneath the deck and find out that the waterproofing system on the deck wasn't functioning, and it's allowing water to get underneath and into the, but this is a metal deck that has concrete on top. But you can see there's extensive corrosion and deterioration as a result of that. Next slide. This happens to be a newer building. This is up in Orlando. Again, the buildings look good from an appearance standpoint, but we did some exploratory on these. We saw some subtle cracks at different areas that we consider to be problematic. We did exploratory examination. Next slide. And this happens to be a beam that goes over the balconies. It has stucco. We've removed the stucco. And what you're looking at is what they call an engineered beam. It's basically made out of wood, 18 inches high. And what you're seeing there is that water's been getting in there for a period of time and has caused it to be structurally compromised. I literally could take a screwdriver and push it all the way through this member, which was 6.5 inches in width, and penetrate through that. It's that failed. We required shoring to be put in there immediately to provide the structural integrity of the building. Next slide. So, and part of the recertification pitfalls that we see is overall, I'd say the system works, but the experience level of the inspectors is critical. And again, I'll use the term bidding of engineering services. It's not always the best price to get the lowest, or best to get the lowest price, because it does have to do with how they're doing the survey and what they're conducting. A lot of times we feel, or we've seen this, where there's a lack of funding. Even if we come to the owners and report that you've got this expense, they're not in a position, and I guess this new bill may address some of the reserved issues, but that's always a big factor. And a lot of times where we see pressure put on engineers to put in a Band-Aid approach, the conditions which I've shown you just by example, none of those are Band-Aid repairs or could be fixed by doing a Band-Aid repair. Next slide. Here's the other factor that becomes critical is, as an engineer under our license, if we find something that is a structural issue or you're at risk, like I did on that last project where I was showing you the wood beams, we are obligated under our license to notify the owner of the condition. If the owner says, that's a nice story, Rick, but we're not doing it, I am obligated to go to the building department and advise them that this is a life safety issue. At that point, I've satisfied my obligations, but I cannot tell you how many times we have produced or gone to an owner and said, you have to shore this immediately. And I've actually had one project where an attorney happened to be one of the owners, and he threatened to sue me unless I changed my opinion that it wasn't correct. So there's a lot of pressure put on engineers. A lot of engineers won't stand up to the clients, or they yield to the client because they're paying them. And unfortunately, that's a violation of their ethics. Next slide. Oh, that's mine. That's all I had.
Rick, one question, we'll move on, and Bethann, you'll have the full time you need. We will go a little over. Rick, I know you haven't seen the new legislation I described in very broad sense, the milestone inspections, having various components, but you still are going to use the same engineering technical standards that you use in doing the inspections. And the good news is it appears that phase 2, once you find something that's an alleged structural deficiency of substance, calls for the possibility of destructive testing. So I take it that you'll be conducting inspections about the same, in the same manner, even with the new legislation. Is that correct?
I would say that's true. I don't see any changes in the fact and the sort of the guidelines that have already been established by Miami-Dade. I do sense, and in discussions with other engineers, I think more engineers are inclined and will be pursuing destructive testing. Doesn't have to be a lot, but at least enough to satisfy themselves. So I do think that's going to be a change in the way engineers approach it.
Thank you, Rick. Thanks for your presentation. We'll now go to Bethann Barrett, the lender's perspective. And to start out, we know that even before the legislation or in the absence of it, the Fannie Mae and Freddie Mac set forth some stringent requirements. But Bethann, why don't you tell us how the lender's reaction to the Surfside tragedy has evolved and what where it stands today from an underwriting and practical standpoint. Bethann Barrett.
Thank you, Bill, and thank you for the invite. As we know, there has always been with Fannie Freddie, which is where mortgages are sold when it's closed for a first or second mortgage. They set guidelines in place in regards to qualifications for individuals and especially condominiums, what they would consider what is a warrantable condominium, something that they feel they go through a checklist and they require questions, answers. Well, due to the Surfside situation, they came out with a new addenda that they added on to this. The form is called the Form 1076. The questionnaire has been out there for quite some time for condominiums, but this addenda was put in place December 2021. This particular addenda asks some very concerning underwriting issues when it comes to building safety, soundness, structural integrity. It asks for, as an insurance company would, it's going to ask for a lot of information in regards to, you know, how is the community operated, what's been done in regards to reserve, what's been done in regards to maintenance. They ask for copies of meeting minutes. This particular form, they ask specifically if there's deficiencies, and what are they? What we are finding is this particular form is either provided to the condominium board to fill out, or it's provided to the property management to fill out, and it requires somebody to attest and sign off on this form. There has been some pushback because condominium boards don't feel that they're qualified to answer these questions, and they don't want to necessarily be held accountable for it if something is answered incorrectly. And you've got management companies that not necessarily have all the information to be able to answer the questions on these. And you've got individuals that are sitting behind a desk and these forms come in and all they do is fill them out, and they don't have or are not qualified to answer these questions based on an engineering report or reserve study report. So this is fairly new to the market. It is creating some stress for individuals that are trying to sell their units, because if this form is not filled out, then the buyer wouldn't qualify for a 30-year mortgage, and they have to find a lender that's not going to sell to Fannie Freddie. So it will create some stress. There was some talk that maybe they were going to hold off on this addenda until the bill was possibly considered, so they thought they'd have some time. But as Bill stated, that this was put into the legislature yesterday, which was not expected. It was supposed to not go back in until March. So we're going to see that is going to, this is really going to be enforced. The other role that I come into is I lend to the Master Association when they need money for a project. And when I look at that, I look at the financial stress of the project on the unit owners. Can they afford it? How much is it going to cost them per door? If they get in trouble, are they going to be able to sell their unit to get out of trouble? What are the delinquencies? How is the community going to react to that? And if you can't get a regular conventional mortgage, it's going to be more difficult to sell your unit, which is going to cause more stress on the association because the unit owner won't be able to pay their maintenance. So I have underwriting guidelines that I kind of, and the other banks that kind of do this type of business, we mirror to what Fannie Freddie is for an individual. You take a look at percentage of investor-owned units. If there's a financial stress, a lot of investors, and those of us that was in banking when the mortgage meltdown happened, investors walk away, they put their hands up, and then it's left for the association to figure out. So there's a stress level there. There's a stress level for amount of the work per door. How is that equal to the actual value of the unit? Is it more than 10%, 20%? You know, if you've got some work that needs to be done to the community and it's more than 40% of the value of your home, what are you going to do? Are you going to put that kind of money in it? Or are you going to walk away? You take a look at the stress level of the dollar amount. You know, certain guidelines within your condo docs and the Florida statute, you have to be careful with how much you raise the percentage of monthly maintenance. And when you say the nasty word special assessment, what's the stress level of the unit owner being able to afford that? As an underwriter to the association, I would not necessarily know, unless I'm looking at past dues, whether or not unit C can afford and unit B cannot. The association has to kind of help provide that that guidance in regards to their delinquency, and they know their community better than ever. And I hear all the time, we're on fixed incomes. We have a lot of retirees. They can't handle this type of stress. And there it lies into the conversation that, they were talking about, is this low income anymore? It may not be, with the fact that now they have to increase reserves, and they're going to have to raise their maintenance fee to cover for insurance and the repairs that they're going to have to take. So this is all a trickle down effect of where you've kicked the can down the road, which is called insurance to go up, which has now caused, delayed maintenance that's going to go up. So when I underwrite all of these, I take a look at all of that. I take a look at the engineering reports. I take a look at the reserve study. If I have a community that comes to me and says, oh, we want to do a 20-year loan because that's what we can afford. Well, your reserve study says in 3 years, you're going to have to do this. In 5 years, you're going to have to do this. In 8 years, you're going to have to do this. How are you going to pay for that when you're paying for a loan for the next 20 years? You're not putting enough money away from the reserve analysis. So it's all a factor of risk related when it comes to underwriting the stress level of projects and future projects, and what the insurance, that's added a whole nother level with, I've had quite a few communities that have reached out to me and said our insurance has doubled. We didn't factor it in because we didn't think it was going to be that much. How can we borrow money to offset the difference and collect it over a short period of time from the unit owners, let's say 10, 11, or 12 months. So there is a lot of things that are going on, and the future will dictate how we manage as a lender and Fannie Freddie, and as me lending to associations. It's all related to the stress level and how much the individuals can afford. And those are the ones where Bill talked about where it's gotten so much financial stress, is where you may have, developers that may look to say, hey, we'll make you an offer on the whole building. How do you feel about that? It may come to a situation to where you've got buildings from the 1980, you've got retirees in there. They can't afford a $30,000 or $40,000 assessment per door. They may have to get paid out, and then that's where you get your developers that come in and tear it down and start over. So the future with the new bill and what's going to happen in the next 2 years will kind of guide how I underwrite, and I'm sure how Fannie Freddie is going to affect to the market itself.
So Bethann, I have two brief questions before we wrap up. One is, you obviously deal with council and managers, and as you said, the boards, the presidents, the associations. Have you had any refusals to provide the addendums or sign the certification since this has come out in the last 3 months, depending upon whether it's Fannie or Freddie, or 5 months, I should say? What has been your experience? Are you able to get these addenda with their understanding this is necessary for a Fannie or Freddie qualified lending program?
Well, I can tell you personally, no, but I have communicated with some of my partners. I talked to a management company, and they have a gentleman, that's all he does is fill these forms out. He says, I fill them out to the best of my ability, and he turns them in. They don't know what happens in, the long run, whether or not Fannie Freddie say yay or nay. And now that this addenda has been added, I can tell you that management companies have added an extra $300 to complete these. The cost of these have gone up. I have talked to some of my partners when it comes to mortgage lending, and they actually have a client, the seller, the management company refused to do it. Their attorney recommended them not to do it, and the board refused to do it. And now they're in a lawsuit to determine whose responsibility it is to fill this out. And ultimately it's the you can't say whether it's the board, because the board signs an agreement with the management company to help them manage the community. So they try to shift that responsibility back to the management company. The management company states, this is more in depth than what our contract states. It's the board's responsibility. So it's still new. to managing through this, there's not a lot of discussion yet out on the forums. So I can imagine with this bill, when it passes, it's going to escalate, and there's going to be some more discussion in regards to, you know, your unit owners are going to have difficulty trying to sell.
Yeah. Second question, have you heard of Fannie or Freddie granting waivers? You know, generally speaking, we were sometimes able in the old days to get waivers on some of the requirements regarding reserves or turnover or levels of occupancy by primary residents. Have you heard of any waivers under these new programs, which do not, by the way, have expiration dates on their guidances?
I can tell you from what I have read and seen, this particular addenda, they have not waived.
Okay.
And it's primarily because of the situation that happened with Champlain. This has created more of a trigger. And honestly, if you're the insurance company is asking for the same information in a sense that this questionnaire addenda is. So for those communities that have to gather all this information and give it to their insurance company, they might as well keep it as a standard, because it's pretty much more of the same information that this addenda is asking for.
Final question, Bethann. We've each talked about the financial stress. Andrea talked about the insurance premium stress. Rick talked about the stress of doing the repairs and the engineering reports and inspections right. You've talked about the financial stress. Do you know if any lenders you're hearing about are offering some alternative, like revolving lines of credit or other loan programs for the interim, the short-term financial stress consequences of insurance, lending, inspections, engineering, and what definitely will be coming in the next 2 years required by the new legislation?
So specifically, I think with this new legislation, it's going to change the way the lenders look at this, and it'll help us understand putting some programs together. So our primary focus when we do a loan to an association, we all know that they balance to a zero budget. So when they have a request for money, all of the unit owners need to identify. So we require a source of use of funds. They have to have something specific. And then we talk about, okay, how are you going to repay this? So when they have a line, just a working line of credit for whatever use they feel that they need, that creates a conflict with source of repayment, because they're not building a repayment into the budget. So if they state that they need money because they have a shortfall with an insurance premium, then we know, okay, what's your plan to cover that shortfall? You can borrow the money from the bank now, but do you want it to be paid back? And are you going to get it from your owners within 6 months, 10 months, or 12 months? There is a situation to where if I'm doing a project and we know that it's a painting, restoration, concrete, I always have the community check with their engineer, architect, and say, how much do you need for contingency? It could be, you know, the minimum that I state is 15%, but it could be 20, it could even be 30 right now, depending on the scope of work. And when they, you know, work with the owners in regards to repayment, they are already factoring that in. It's not an after the fact, okay, now we spent more, you know, 30% more than we thought we should. It's easier to go in with getting it than to ask after the fact, have it beforehand. So more of this is you have to be proactive instead of, unfortunately, where we are is reactive.
Thank you, Bethann. Those were very practical words of wisdom. Any final comments from any of our panelists? Andrea, anything, or is it all stay tuned?
It's just beware, and I think we're all going to keep our eyes attuned to the legislature to see what comes through, and then it's going to be a waiting game to see how it goes into effect. Does it get them relief, and if it does, how long?
Thank you, Rick.
Don't have anything else, Bill.
Thank you, Rick, and thank you, Bethann. And I'd like to thank all our panelists for these very elucidating, informative remarks, very practical. And Jin, I will hand it back over to you.
Just a final word. Thank you everyone for participating, both our panelists as well as our audience. We will make the recording of today's program available on our website. So just go to carltonfields.com and search for our development industry group. Thank you again, everyone. Stay tuned. We're going to have another program later this year. It will be another interesting and informative session. So thank you, everyone.
Thank you again.
Bye-bye.
To you all. I appreciate your participation. Bye-bye.
Bye.